Last week, I gave a speech where I detailed the fact that we at the SEC have been treating exchanges with nonprofit kid gloves for the better part of a decade, while the exchanges have been profit-making entities. And as you and I know, and everyone on that floor with you knows, profit-making entities can be counted on to make profit. That's why our stock exchanges are structured the way they are, with 13 exchanges, 12 of which are owned by just 3 corporate entities. That's why investors are paying a fortune to connect to those exchanges. And investors are paying for all of this 1 microsecond at a time, and I'm out to change that.
One of the problems you have is what you call the public and private feeds, which is to say that there is the public feed with which, for example, the NASDAQ or the New York Stock Exchange feeds to the public the numbers in terms of where stock prices are at any given moment, and yet there's a private feed that they charge a lot of money for to a lot of private firms.
Well, that's exactly right. And here's the key point to see. The exchanges run both feeds. That is, there's a public feed that the law requires them to provide for stock prices, and there's a private feed they sell for profit, and they run them both. That's sort of like letting Barnes & Noble run our public libraries and then being surprised when there's no books in the library. Of course there aren't. The exchanges compete with the public feed, which is why it's so slow and underinvested in. And again, that's something that needs to change.
How would you propose changing that? Does that mean having the exchanges not be allowed to profit on it, or would it require somebody else stepping in to beef it up? I mean, if you're looking for a clear separation, what's the answer?
It's a good question. I think what we need to start doing at the SEC is stop pretending that profit-making entities are going to do anything but try to make profit. Every time they try to raise prices on investors, we at the SEC have to approve those filings. And what I'm pushing for is for us to get serious about making them show that competitive pricing is driving those requests. And if it's not, we can stop them from raising those prices on investors, and we should. Is
that an argument for broader regulation where you treat these entities as utilities rather than a profit-driven enterprise?
Well, I think we have 2 choices. Either we can have the nonprofit exchanges we used to have, which we can treat with kid gloves. We can think of them as in the way of a utility. Or we can acknowledge the fact that what they're out to do is make profit. There's nothing wrong with that. They're designed and indeed in ways have to pursue profit. But then we should treat them like that, and we should review their filings very closely to make sure that they're out for investors and not their own pocket.
Given that all the exchanges, most of the exchanges around the world are for-profit enterprises, is there any argument to be made that there has been innovation in this space because of competition?
Well, for sure. And just to be clear, over the last 10 years, there's been a great deal of innovation and investment in our stock markets. In many ways, it's cheaper to buy and sell stocks than it ever has been.
Exactly.
So I think that's right, Andrew. It's a very fair question. But my answer is an area where there are falling prices is a great place to hide monopoly rents. And I can tell you that the cost of connecting to our stock exchanges has risen year over year. At the same time, the cost of connecting everywhere else in the world are falling. And that shows me that we might not have the kind of competition investors deserve.
Sure. If you thought about having a summit on what the heck inside information is anymore in the Twitter world and what's fair and what's not, and I mean, do we need to have a whole new, I don't know, approach to how we decide, you know, what you can do and what you can't do? I'm unclear whether a Twitter comment is like a press release. Is it?
It's a good question, man. And I have to be careful because as an SEC commissioner, I can't comment on anything that might come before us. But here's what I will say. If all of you who are running this show aren't sure about the law of insider trading, that means the markets don't know the law clearly enough. And that's not good for the people that might be informed and in a position to trade. That's not good for investors who we're trying to protect. And if you're wondering whether it might be time for us to clarify this, I am too. And
so the question, therefore, is then why has the SEC not issued guidance on this issue yet?
Well, to be fair, we have clarified under 2 rules about a decade ago some of the details around insider trading, rules 10b-5-1 and 10b-5-2. But I think you might be right that it might be time for the SEC to dig in on these questions. I can tell you that on Capitol Hill, a lot of members of Congress have suggested it might be time for us to have a clearer statute.
Do you have support from the other commissioners to issue guidance on this topic?
On insider trading, well, here's what I'll say.
Insider trading, or even just the use of Twitter and other social media by executives.
Well, I should say, by the way, that we have issued some guidance in the area, although it's quite old. And here's what I'll say. I know every single commissioner is concerned about making sure that investors have a level playing field when it comes to the use of Twitter and other things. And again, I can't prejudge any matters, but I'm sure that we are going to be focusing on questions around how to best define insider trading, especially when it comes to the use of social media.
Commissioner, we got to run, but I have one very, very quick question. Commissioner Clayton has proposed to modernize the definition of an accredited investor, typically somebody who had $1 million or more to get into private investments and other things, wants to lower that bar. Where do you stand on that issue?
You know, Andrew, I haven't talked with the chairman about it directly, but here's what I'll say. To me, the solution to protecting Mr. and Mrs. 401k in the United States is not to put them in private equity vehicles. I think we can broaden the opportunities these investors have without putting them at risk in the way that proposal might.